Global oil prices have fallen over 40% in the past 6 months. They're now at their lowest level in almost 5.5 years. Here to discuss what this means for the global economy is the FT's economics editor, Giles. So Chris, we've seen this huge fall in oil prices. What does it mean for the world economy? Is this equivalent to another dose of QE?
Yeah, it's like a big tax cut on average for the world economy. There's winners and losers, of course, but generally it's thought to be very good for the world economy and has been very good in the past. 1986, a very similar sort of size fall, and even 2008, 2009, big size fall. Very good initially for the global economy then. Why is that the case? Well, because any consumers of oil, it's like a great big tax cut for them. They have more money and we think normally they'll spend more of it than the people who it's going to hurt, the producers of oil, are going to sort of spend less. So you actually get more spending in the world economy. Now, rough figures, what are we talking about? 25% fall in oil, the IMF thought would generate about 0.4, 0.5 additional expansion or additional GDP for the whole world economy over a 2 or 3 year period. So it is sizable, and we've had more than that. We've had oil prices coming down nearly $40. So this is really should take away many of the fears of a slowing global economy we've had over the past 6 months or so.
But you do think people are going to actually spend this effective tax cut? They're not just going to bank it and pay down debt and things like that. You think they will actually go out and use it and spend? That's
what they've done in the past. So that's the million-dollar question. If they do bank it, then you don't get a big boost. And so the IMF's forecasts are really hedged. They say you could get a much bigger boost if it also has a simultaneous effect on confidence. And that means that if you actually got a less than normal effect on confidence, you'd actually could get a much smaller effect. And that's where some people this time around are thinking, well, maybe this is one of those times where actually people are a bit nervy about the global economy and might be a time they want to bank it rather than spend it. And that's what it all hinges on.
Yeah, indeed. I mean, these are some of the points the International Energy Agency picked up on in a report last Friday, saying that the lower oil price might not necessarily stimulate as much demand as we'd seen in the past for things like oil. They're looking at some of the big petrodollar countries, for want of a better word, or bigger producers like Russia, for example, saying that because they're suffering from the lower oil price, they're not going to spend as much in future. I mean, I suppose it's very different from saying lower oil demand to lower spending, I guess.
Yeah, I think lower oil demand is what they were talking about rather than lower general demand for other goods and services. So I think that's where we want to see the action. We want to see people saying, look, I'm actually better off than I thought. It's the reverse of 2011, where food and oil prices, energy prices were rising globally and people found themselves worse off than they thought. Now people are going to be better off than they thought. And so long as they go and spend a reasonable amount of that money, then that can create a self-sustaining uptick for the global economy.
But what does the lower revenues that the petro-producing nations are getting? What does that mean? I mean, for the global economy, if anything. I mean, these countries aren't going to invest as much money in, I don't know, US Treasuries or something like that going forward. Is there any impact there that you could see?
The countries, let's say Norway would be the classic example of a country that didn't spend its oil revenues but saved it. So it will save less, and so there will be a smaller flow going into US Treasuries. So you might get some movements in currencies, but really, I mean, especially if the dollar keeps rising as it has been now, some of these things are going to be sort of natural hedges. Say for Russia, if the ruble falls like crazy, then its oil price in ruble terms hasn't fallen nearly as much as it would in dollar terms. So there are some natural hedges. So I don't think we should think of these things as things that will sort of blow apart the general economic picture, that we're likely to see things better than they otherwise would have been. That doesn't mean they'll necessarily be brilliant.
Should we, and will central banks indeed be worried about deflation because of this big drop in the oil price?
Well, I think it depends which central bank. So the ECB is the one where we already know they are worried about it. The chief economist has gone on record saying that this time round is not the sort of time you'd want to sort of ignore the price drop, because it's going to have a temporary effect on inflation, and then inflation is going to come back again. ECB, Eurozone inflation is very likely to go negative. If that has knock-on consequences to the population there, that they do think actually now's not a good time to spend money, then you can see there'll be even more reason than there already is for the ECB to be pretty aggressive in the new year.
Okay, Chris, thanks very much. So, the large fall in the oil price over the past 6 months should provide something of a tax cut, some stimulus for the global economy. It seems likely that consumers probably will spend this money as they have done in the past, so it could give a shot in the arm for global growth next year.